From a tax diversification standpoint, would it ever make sense to fund a taxable account, not a 401k, not your Roth IRA? And if it ever would make sense, when would you do it? When would be an ideal time? I've got that and more coming up. What is your tax shelter strategy? What is your strategy looking at all 6 areas of your financial life, your investment planning, your tax planning, your retirement planning, your present financial position, your day-to-day cash flow, and all 6 areas of your financial life? What's your strategy when you're contributing and saving up and investing for your future so that you're doing so in a really tax efficient way? It's a mouthful. We call it your tax shelter strategy. If you got a better term for it, please let me know. It's one I'm struggling with, but yeah, that's the decision to say, no, it makes the most sense for you to be funding your 401k pre-tax and then maxing out your Roth, or funding the Roth side of your 401k up to the company match and then contributing to, max out your HSA, or maxing out all of those. What's your tax shelter strategy? What makes the most sense for you this year? And then as changes happen, either in your financial life and your income, with tax laws, with your goals, how do you adjust your tax shelter strategy? Hopefully, woven into that strategy is another kind of nerdy term, tax diversification. We all know what diversification means. Don't have all your eggs in one basket, but from a tax standpoint and from a retirement account savings standpoint, you want to have diversification there as well. We get a lot of questions about Roth conversions. Love the Roth conversion. Makes a lot of sense. You got to rule it in, rule it out every single year based on your situation. Sometimes people say, should I convert all of my IRA dollars? Should I only have Roth? Well, there's a lot of times when that doesn't make sense, and you probably wouldn't want to do that. Work with your CFP, but that's an example of tax diversification. As you're building your wealth, as you get closer and closer to retirement, do you have some dollars that are pre-tax, where you've gotten a tax deduction along the way, and then when you pull the dollars out, you'll pay ordinary income taxes on that? Do you have, hopefully, a lot of your wealth growing tax-free, tax-sheltered and tax-free, which is Roth 401k, Roth IRA, something like that? And then, do you have some dollars? Would it ever make sense to have some dollars that are growing outside of tax shelters? So a taxable account, an individual account, a joint account, a trust account, something like that, where, yeah, it's growing, and then the dividends and capital gains, those are taxable to you. They're going to land on your return, but it's more flexible. You can draw dollars out, even though it's taxable to you as you touch it, or as dividends are paid, or interest is paid. You can touch it. You've got more flexibility. Would it ever make sense to do that? Well, yes, it would. And enter in a great question from fan of the show here on the YouTube channel. Got a few different replies. I replied to it right away, as I try to do with most of the comments. But I thought this was a fantastic question because it kind of mines the depths of kind of looking at your financial life from a comprehensive way. I already mentioned there's 6 areas to your financial life, and just 4 of them that clearly need to be considered with this. Your present financial position, so your cash flow, that's going to weigh into when and whether this would make sense. Your tax picture, tax planning, your investment planning, right? You might want a specific investment strategy within a taxable account, and your retirement plan. But guys, it certainly impacts those 4, but it's definitely going to impact the other 2 as well. Estate planning, right? Taxable dollars will get a step up in basis. You might even inherit some taxable dollars from a family member, so you need to be aware of estate issues. Plus, taxable dollars don't automatically have beneficiaries attached to them. You want to add a TOD. And then a big reason why a lot of people will consider investing or saving up in a taxable account is because they plan to retire early for health insurance reasons, right? It's helpful from a tax standpoint to have some taxable account dollars. So that's protection planning. So it's all 6 areas, guys. I know I'm talking, in circles, but guys, it's a fantastic consideration, fantastic question. And you got to look at all 6 areas of your financial life. So it certainly depends on your situation. Okay. But let me share a couple of times when I would say probably is not going to make sense to be funding a taxable account, as well as a couple times on the other end of the spectrum when it certainly will make sense to consider funding a taxable account, and then when you should do it, sort of answering the question here that we received. So a couple of times when you most likely wouldn't want to even consider funding a non-IRA, non-tax sheltered, so basically a taxable account, is if you have a 401k available and you're not even getting the full company match. And because typically there's some free dollars on the table there, you want to contribute at least, even if you say I don't want to do a ton to my 401k or whatever, at least get the company match, okay? And before saving into a taxable account, make sure you get that. And then the other time where I probably wouldn't fund a taxable account is if you're eligible, if you're able to contribute to a Roth IRA, but you're not maxing it out. And the reason why I would say that is many people aren't aware that their Roth IRA has some built-in flexibility as well. When you contribute to a Roth IRA, you can actually pull your contributions right back out, no penalty, no taxes, no issue. Your contributions you can pull right back out, and it doesn't even matter what age or how long you've had it in there. The restrictions come on the growth. And so the Roth IRA has a lot of flexibility. So I likely wouldn't fund a taxable account if you're not getting your full company match from your 401k and you're not maxing out a Roth IRA if you're eligible. On the way other side of the spectrum, the times, that you clearly should consider using a taxable account. Obviously, there's an infinite number of scenarios in between these. But on the other end of the spectrum, if you are fully maxing out all tax shelters available to you, you're maxing out your 401k, your catch-up contribution, maxing out your Roth if you're eligible to do that, doing backdoor Roth, if you can do that, doing mega backdoor Roth, you're maxing your HSA, and you still have dollars that you're like, yeah, I'd like to save more for retirement. Well, then it's clear, right? I mean, those are the times when investing in a taxable account are just clear and obvious. And then the other, and I would say this one is clear in depending, if you plan to retire well before 59 and a half. And the reason why I hesitate on that is, that's just how I talk and it can annoy some people, but also because there are some strategies. If you're going to be retiring before 59 and a half, that you can't really touch all your IRAs, your Roth IRAs, the growth on those. There's some limitations. That'd be an early withdrawal penalty. Well, you can skirt that penalty in a few different creative ways. If you're, retiring in the year you turn 55 or after, technically you can access your 401k dollars without a penalty. Would be taxable for the pre-tax ones. There's some other creative strategies you can use, but oftentimes if you're planning to retire before 59 and a half, you're likely at some point going to want to start saving in a taxable account and getting that broad tax diversification. Okay, I hope all of that was helpful to you. All of that's just context leading us to the question that was asked, and that is when? When would you do it? When would you start funding that taxable account? There's not a one size fits all, and you can see some of the comments here. A few people said I started 5 years and 8 years is going to be plenty of time. My immediate response was, oh, fantastic question, but 8 years should be plenty of time. I would say around 5 years, okay? And it certainly depends. If you're on that, I've been maxing out all of my tax shelters and I have more money I want to save, then don't worry about the 5 years, the 8 years or whatever. Just start saving into that tax shelter. But if you're intentional, if you say, as part of my tax diversification, I intentionally want to have some taxable dollars, you want to make sure you're doing it at an appropriate time. It seems like 5 years would be appropriate before retirement. Too soon, like just 1 year before retirement, you're probably not going to have a lot of time to really save up a meaningful amount without sacrificing your contributions to your 401k or your tax shelters. 5 years gives you enough time where, you can still, because balance is going to be key. You don't want to give up the meaningful part of your tax shelters, right? You don't want to give up maxing out your Roth IRA. You don't want to give up getting the full company match or maybe even contributing 10 or 15% to your 401k. But it's extra dollars. 5 years approximately gives you enough time to start saving up a critical mass. Now, what do I mean by critical mass? And this is where you're going to want to work with your CFP, and it's not one size fits all. But the majority of people, right, that are looking at, building up some tax diversification because they want to retire in their early 60s or late 50s, what they tend to do is say, I feel comfortable with 50 grand in cash or 25 grand in cash or whatever. And their way of kind of building up in a taxable account isn't investing in a taxable account. I mean, that can make a lot of sense. But oftentimes people look and say, they start adding extra to that cash. Okay. And within 5 years of retirement, saying, if I feel comfortable at 50 grand in cash, start building that up. So maybe you retire and there's 100 or 125 grand or something in there. That can make a lot of sense because those dollars typically are the ones that you're going to use early in retirement. And so 5 years is still a short time horizon. So that money is reliable and it's there and you don't have to worry about market volatility. But plus, the interest on that is going to be taxable to you, but there aren't going to be capital gains that you're going to need to worry about. And therefore, as you draw dollars out, maybe right at the beginning, the first year or two of retirement, very little tax impact will allow you to be eligible for advanced premium tax credits if you're getting your health insurance through healthcare.gov. Very little tax impact, so you could do Roth conversions. Like, it will be very, very flexible. So work with your certified financial planner to first make sure that you've got the right tax shelter strategy. Second, make sure that you've got the proper tax diversification. Third, determine, does it make sense for you to be saving up at some point into a non-tax sheltered account, a taxable account? And then finally, if so, when? And then finally, where and how? Because even though I mentioned cash is a very common place to do it, it doesn't make sense for everyone. We have a lot of clients that are stuffing a lot of dollars into taxable accounts and saving up and investing those dollars, making sure you've got the right strategy for that. So work with your certified financial planner. They've got to look at all 6 areas of your financial life, because that's exactly at the intersection of that. That's where this decision sits. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.